All right, in this report, I'm going to talk about employer costs and for employee compensation. This report comes out quarterly, and it is the employer's perspective on labor costs. There's always a difference between what the employer actually pays and what the employee receives. There's leakages. One example would be the employer has to pay payroll tax. That goes to the government. You don't see that on your paycheck. So the employer costs always exceed the amount that the employee actually receives. This is an important report because if we see employer costs going up, that can make labor more expensive, meaning employers would want to reduce labor or replace labor with technology or capital or mitigate those costs in other ways. So the higher cost would be a burden to employers, and this helps us see what that burden is. Another way of thinking about it is if employer cost goes up, like any increased cost, that is a disincentive to produce. But there is another side to this, which we saw from the employee's perspective when we looked at the personal income report or the real earnings report, what employees actually get. To them, they're getting a higher amount of income from these higher wages or benefits that employers are paying. And that can actually be a stimulus for the economy. It's almost like supply versus demand side economics. The higher cost of production for an employer tends to curtail supply, creates a negative supply shock to the economy. But the increased wages or benefits to employees tends to increase the demand in the economy for goods. So it creates a demand shock. The net effect is what we would need to consider. Okay, let's now take a look at the first table. This is showing the breakdown of compensation by compensation category here, and then by workers. So you've got civilian workers and the costs in dollar terms and percent of compensation, and then private industry workers, same breakdown here, and then state and local government workers. When we use this report, they do compile information on state and local government workers, but not federal workers. So no federal employment information is available here. Civilian workers essentially includes both private industry workers and state and local government workers. And then again, if you want the details of each, you would look at these columns here. Let's focus first on the civilian workers and look at the costs and percent of compensation. Well, total compensation is going to be $37.10. That makes up 100% of all compensation. Now, when reading these tables, the first indention tells you how they're breaking down total compensation. So they're breaking it down into wages and salaries, which is $25.47. That makes up 68.6% of compensation. And then they're breaking it down again into total benefits, which is $11.63 and 31.4%. This plus this should equal this, and this plus this should equal this. There could be rounding differences, but for the most part, you're just breaking down into slices of the pie. So the pie is $37.10. $25.47 comes from wages and salaries, $11.63 comes from total benefits, and similarly, if you want to think of percentages here. This is very telling because it shows that almost 70% of the wages of the compensation is in the form of wages and salaries, and about 30% is in the form of benefits. And then it breaks down total benefits into things like paid leave, supplemental pay. Again, look at the next indention: insurance, retirement and savings, and legally required benefits. So if you were to add up $2.72 and then $1.09 and $3.22, $1.92 and $2.69, this, and this should equal the total benefits. And you can do the same thing with the percentages, right? 7.3%, 2.9%, 8.7%, 5.2%, and 7.2. And then you can go into even more indention. So if you want to look at paid leave specifically, vacation time, holiday time, sick time, personal time, so on and so forth. So just understand how to read the table. But the broader information is probably most relevant to evaluating the economy. Because what it tells us is not only at a given time how much employers are incurring in costs of employment, but it also tells us how that changes over time, right? So we can watch this cost of labor and see if it's growing. And if it is, then we have to wonder how that's affecting the supply side of the economy. Okay, this also, by the way, gives you a sense, if you're going to go in business, of the true cost of labor. If you work for a business, you say, well, I make X dollars an hour. But remember, if you were to take over that business, you'd be paying a lot more because you have all these additional costs that are above and beyond what the employee receives. All right, let's continue down. Let's go to Table 2. And Table 2 gives us a little bit more detail in terms of occupational groups. You'll notice we've now converted the civilian workers into rows. Total compensation, 3710, 100%. That's what we had up here, right? Total civilian workers, total compensation, 3710, 100%. And then the next line was civilian workers, wages and salaries, right? And 2547 and 68.6. So you can see it up here. And you go to wages and salaries, 2547, 68. So just understand that this row, or that column, has been converted into a row here. But then we get more detail, right? We get the occupational groups. So let's just look at a couple of these. So if we look at management and business and financial, you can see that the total compensation was $69.73. Okay, and that represented 100% of income. $47.63 was in wages and salaries. That's 68% of income. Okay. $22.10 was in benefits. That was 31.7% of income. Okay. And then we could scroll down. Let's look at a different one. Let's look at transportation and materials moving. Okay. So you got $30.47 in total compensation, 100% of income. $20.11 wages and salaries, 66% of income. And then $10.36 in total benefits, 34% of income. So you can compare and contrast different industries. And let's, for example, look at benefits and the percentages. Which industry has the highest percentage of benefits? This is pretty high here. Registered nurses, 35.1. This one's high, 35.9 for hospitals. So it looks like healthcare seems to have a higher percentage of benefits relative to wages and salaries, right? 64.9% for salaries, 64.1% for salaries. We could also look at the lowest numbers. So for benefits, the lowest number I'm seeing here, again, and I'm doing this right now, so I could be wrong, but let's say 24.1, sales and related, and wages and salaries make up 75%. Well, that kind of makes sense because in sales, a lot of the compensation is commissions, okay? And so it's less about fringe benefits and more about getting paid a dollar value. Okay, so just another way of looking at the employer costs. Scroll down. Table 3 breaks it down for state and local government workers by the different groups. Nothing really new there, right? Same format. And then scroll down. Table 4 breaks down private industry workers by the groups. Again, same format. Table 4 continued. Table 5 looks at private industry by bargaining. So for example, union workers, total compensation 48.15. Okay. Non-union 33.53. More costly if you have a union labor force than if you have a non-union labor force. Okay. And look at the breakdown. So in union, you have 59% wages and salaries, non-union 71%, okay? Which means unions tend to emphasize fringe benefits. Non-unions don't. That's consistent with what we talked about in the union videos. Unions may be better at negotiating for fringe benefits for employees than non-union workers. Scroll down. This one looks at, this is just continued, Table 5. And then Table 6 is telling because this looks at the employer cost by firm size. So if we look at all workers, smaller firms, let's say those with 1 to 99 workers, cost of total compensation 28.77. But 500 or more workers, right? 49.46. So notice that the more workers they have, the more costs there seems to be in terms of each worker. And you could also look at benefits. Smaller firms that have 1 to 99 workers, 26% of compensation is benefits, whereas firms that have a lot of workers, 35% is in the form of benefits. So it makes sense. Bigger firms are more likely to provide things like health care and supplemental pay and insurance and all of that, pensions, as opposed to smaller firms. So it drives up the cost, right? Makes labor more expensive. And then finally, Table 7 shows regions. And so Northeast, South, Midwest, and West. Look at the differences. So in the Northeast, we're at $39.22. The South, $30.48. The Midwest, $33.05. And the West, $39.37. So the most expensive is in the West. Okay, we're in the West. And you can see that Pacific, right, $42.04, even higher. The cheapest is $30.48 in the South. And that makes sense because a lot of companies have relocated to the southern regions because labor is much cheaper there. And it makes it, from the producer standpoint, more efficient, more cost efficient. Okay, that's it. Good report, kind of complements the real earnings report we looked at last time, and gives us a sense of how employers see things. If you have questions, let me know. Thanks.